Okay, hi everyone, and thank you for joining us for another one of our WESC webinars over your lunch hour today. My name is Josie Fries, and I am WESC's Marketing Advisor. Our topic today kicks off our 5-part webinar series called The Top 5 Legal Matters for Entrepreneurs to Consider. And the remaining 4 topics in this series will be taking place every Wednesday in January. This one just being the first one here in December. While I'm talking here, I'll actually just leave up these upcoming topics. You can take a look at what's coming up in January as well. Registration is not open yet for these January ones, but they will be hopefully next week, so stay tuned for that. Okay, so our first topic in this series is how to choose the right legal structure for your business, and it is presented by Freba Jalal, Associate at W Law Group. If you have any questions for Freba as we go through the presentation today, please submit them through that Q&A box, not the regular chat box. But do feel free to use that regular chat box to introduce yourself and tell us a little bit about your business. As always, this webinar is being recorded and will be available for on-demand viewing. You'll receive an email tomorrow at this time with the link to the recording, so watch your inbox for that. And with that, Freba, I'll pass it over to you to begin the presentation.
Thank you. Okay, hi everyone. I cannot see or hear you, but I'm told you're here, so welcome. I hope today's seminar is useful and you get some information that will help you with your businesses. My name again is Freba Jalal. I'm a lawyer with W Law here in the city. A little bit about my practice. I'm a corporate commercial lawyer. Basically, I work with businesses, so small to medium-sized businesses are a majority of our clients. I help sort of from the start of a business in terms of incorporation and registration and whatnot to whatever help the businesses might need during their operations, contracts and buy and sell when a business is being sold or bought out. I help with all of that. I also do practice in the area of financial services. So if you're taking out a business loan, some of you might have gone through that with banks or even WESC. So I help on the bank side and also on the borrower side with transactions of that kind. I also do estate planning and estate administration, so drafting of wills, powers of attorney, healthcare directive, whatnot, and helping executors when somebody passes away in terms of looking after the estate. I'm excited to be here today. I'm excited to present this, and so I want to thank WESC for the opportunity. As it was mentioned earlier, it's the first of a series of legal webinars that our office partnered with WESC to put together. So we're excited and we're hoping these topics are relevant to you either now or as your business starts or continues to grow. And the first one is business structures. Okay, so today, what we'll talk about today is sort of an overview of the different legal business structures that are available for businesses. I'll be focusing, a lot of my discussion will be focused on Saskatchewan. However, a lot of the discussions and the information is sort of similar for other jurisdictions in Canada. There might be similarities also with other countries, but for our purposes, we're focusing on Saskatchewan. We will talk a little bit about federal incorporations as well. The idea is that you understand the basics and the differences, the advantages and the disadvantages in terms of why you might prefer one business structure over another. And we'll briefly touch base on the transition from one business structure to another. As I go through the presentation, you're welcome to type in questions that you may have. I'll try to keep an eye on the Q&A box throughout the presentation. but I'll definitely check at the end to make sure I've answered any questions. So business structures are important, and it's important to sort of think about them at the beginning of your business before you even start your business, because setting it up right from the start a lot of times is much easier than trying to change things down the road. Having said that, of course, there's the possibility of changing your business structure as you continue operating. The three common types of business structures that we deal with are sole proprietorships, partnerships, and corporations. Each of these structures have different implications on your business from a liability perspective, from the tax perspective and succession planning and all of that. And we'll touch base on all of those as we go through the presentation today. So first of all, sole proprietorship. It's sort of the simplest way to set up a business. A sole proprietor is you can also call them a self-employed person. The person setting up the business is the business, really. So if I, Freva, decide to open a cafe and call it Freva's Cafe and just run it as a sole proprietor, I am the business. I would have full control of the business, so I make all the decisions. I get all the profits. I'm responsible for all the expenses. It's a very easy business to set up from at least a legal perspective. I would still need to register my business name under the Business Names Registration Act in Saskatchewan. So I would register Freva's Cafe. I would, of course, need a business license. Depending on the type of business, I may or may not need other types of certifications and licenses and whatnot. But from a legal perspective, in terms of setting it up, there's not much more to it. Some of the issues, though, so because it's so simple to set up, it's very low cost as well in terms of the setup. However, there are some issues to think about. So as I mentioned, I have full control of the business and I get all the profits of the business. But I'm also responsible for all of the debts and obligations of the business. And my liability would be unlimited. So suppose somebody walks into Freva's Cafe and falls down and gets hurt and they decide to sue me or sue Freva's Cafe, they're in essence suing me, Freva Jalal. So I'm personally liable to that person for any liabilities of the business. And so if they get a judgment against me, my personal assets are open to that kind of judgment. So if it's my house or my car, I mean, there's exceptions to what they can and cannot seize. But the idea is that all of the liabilities are my personal liabilities and it's unlimited. So whatever the amount of liability might be, I am exposed to that. There are ways to mitigating that risk by getting a business, an insurance that's appropriate for my type of business. But that doesn't cover every type of liability. So liability is a big issue for a lot of sole proprietorships when you're running the business in your own name. The other issue might be difficulty raising capital. So I'm the only one invested in the business. So I would be investing probably my own funds. If I need any additional investment, I would have to probably get a business loan. And that could have interest and all those implications. Lack of continuity in the business. So with a sole proprietorship, Freva's Cafe exists because of Freva. So if I die, the business is technically done as well. I mean, the assets could be sold after I die, but the business dies with me. So that's also one concern that some sole proprietorship that you have to be aware of when it comes to sole proprietorships. One more thing I should mention in terms of taxes for sole proprietorship, as I mentioned, all of the profits of the sole proprietorship are my own profits. So the way it would work is when I get the money out of my business, it gets reported on my personal income tax. And most of you would be aware that in Canada, we have, for personal income, we have brackets. So if your income is up under a certain amount, you get taxed at a different rate. And as your income increases, the percentage of tax increases as well. So depending on the income of the business, it could be an issue in terms of how much I pay in taxes. So if my income is high, then I pay a lot more taxes. Okay, so the second type is partnership. The easiest way to, I guess, explain a partnership is basically it's a number of sole proprietors coming together and starting a business together. So it's one or more people combining their resources with a view to making profit. Whether they make a profit or not is a different question. But generally, it's very easy to set up. So partners generally share the management of a business together, and they are responsible for the debts and obligations incurred in the business. And this is with a lot of partnerships, especially the smaller businesses. If you're talking about a very large business, the structure might be a little bit different, and partners some of them might be hands-off than others, but in most of the small businesses, all partners are involved. They put in capital and they sort of run the business together and have different responsibilities. One thing to be aware of is the responsibility or liability that each partner is exposed to. And as a partner, you're exposed to any liability that arises as a consequence of the actions of other partners. So if I'm running Freba's Cafe with a partner and my partner goes ahead and buys a whole bunch of kitchen equipment, whether I authorized it or agreed to it or not, doesn't matter. I am as much responsible for the whole price of the equipment as my partner is. And so you cannot protect yourself from liability by saying that your partner made those decisions. In fact, you are fully responsible for the entire amount of that liability and not just the 50% because you're only a 50% partner. So it's a big thing to remember, especially if you're going into a partnership where you have minority partnership interest, let's say 10%. It's important to remember that you're exposed to 100% liability, even if you have 10% of interest in the partnership. So setting up a partnership is quite simple, very much like a sole proprietorship. From a legal perspective, all you need to do is register a business name, you get your business license, any other certifications that you might need, but that's about it. You don't need to legally register a partnership in order to create a partnership. You don't need to have a partnership agreement to create a partnership, although it's recommended, and I'll touch base on that briefly. In Saskatchewan, partnerships are governed by the Partnership Act. And the Partnership Act sort of sets out some of the bases of how partnerships are operated and what happens if a partnership leaves a partnership, and sort of the rights and responsibilities of the partners. Through a partnership agreement, though, you can set up additional terms in the partnership. You can also change some of the default provisions from the Partnership Act. So for example, if you are looking to establish a partnership, 3 of you One of you has 50%, the other has 30, the other has 20. You can set all that up in a partnership agreement, and it's highly, highly recommended to have one in place. The other things you can address in a partnership agreement would be, what happens if a partner wants to exit the partnership? What happens if a partner dies? You might find yourself in business with your partner's spouse because your partner died. So it addresses those situations. You can also have provisions in the partnership agreement regarding liability. Although you can change your exposure to liability in a partnership agreement, you can have some sort of indemnities where other partners will sort of cover you for the liabilities. We will be talking about partnership agreements in quite a bit of detail in one of our later seminars. So I'm not going to go into too much depth in there, but it's a very important document to have in place. In terms of partnership income, so it's very similar to a sole proprietorship. Partnership income is taxed in the hands of partners. So if I am operating a partnership with a partner and we're 50-50 partners, then I get half of the profits. It gets reported on my personal income tax, and I pay taxes on it based on the amount of income and what bracket I fall into. So very similar to sole proprietorship. Again, depending on the amount of the income that we receive, taxes may or may not be an issue. So something to remember if you're considering partnership. I've added limited partnerships because you might have heard of limited partnerships. It is still governed by the Partnership Act in Saskatchewan, but it's a much more complex structure to set up. It's not commonly used except for some specialized industries. You would see them in real estate quite a bit. There's tax advantages to setting up a limited partnership. Basically, what a limited partnership does is there's a general partner who has 100% liability for all of the partnership liabilities, and then limited partners who are only their liability is limited to the amount they put into the business. But again, it's not a commonly used structure, especially with small businesses. So I'm not going into too much detail, but I thought I would just sort of talk about it in case you've heard of it and are wondering. So like I said, partnerships are pretty easy to set up. Costs can be low, but depending on whether you decide to, have a partnership agreement in place and whatever else you might or might not do. But generally speaking, the costs are lower. It gives you additional sources of income, so you can bring in partners who will invest in the business. They'll have a stake in the business. They can help you run the business. So it's a lot more flexible than sole proprietorship. And when the partners come in, they're sort of in the same boat as you. So their investment you don't pay them sort of the same interest rate that you'd be paying on a bank loan. I talked about unlimited liability and your exposure to unlimited liability. That's a very important point to remember about partnerships. You might have difficulty in raising additional partners or, additional capital. It depends. You can add in more partners, but the more partners you have, the more control you sort of lose because each partner has a say and has a vote. So you might want to limit the number of partners. In a lot of small businesses, there's 2 to 5 partners at the most. It might be difficult to find the right partners. You might get along with somebody really well as a friend or family member, but running a business would be entirely different. So that can be a challenge for some partnerships, especially as they grow and they want to bring in more partners. There's of course the possibility of conflicts arising because if you don't agree on things, like I said, partners are responsible and liable for all of the actions of the other partners. So it can be a difficult situation where your partner can actually bind you without your approval to certain liability. They can take out a bank loan, for example, and so that's a big risk. So you have to make sure that you are in business with the right partners. Lack of continuity can be an issue as well, similar to sole proprietorship. So if it's just the two partners and one of them dies, the partnership is technically dissolved. And so that can be a concern. And I think I touched base on succession as well. If a partner dies or if a partner wants out again, if it's just a two-partner situation, then there's issues with continuing that partnership. So I just want to mention that while I'm sharing my screen in full in presentation mode, I'm not able to see the Q&A box, and I apologize. So if you've added any questions, I'll be sure to check everything at the end and answer all the questions. So feel free to type in the questions as they come to mind. Okay, so the next one we're going to talk about is corporations. This is sort of the big one. Corporation is basically a separate and distinct legal entity. So when you're creating a corporation, you're creating a whole other entity that's separate and apart from you as the owner of that business. Corporations in Saskatchewan are incorporated under the Business Corporations Act. So in terms of setting up a corporation, you have to register your corporation. A lot of times you do need articles and you need bylaws to sort of get your corporation going. That's where sometimes the costs can add up. A lot of times most people aren't able to have all that or draft all that themselves. A lot of times you need a lawyer to even help you set it up and do the incorporation. So the costs can come in from those sources. There's also additional fees of register or incorporating a corporation with the corporate registry in Saskatchewan. I should also mention that once you set up a corporation, there's additional record keeping and reporting requirements that you have to do. For example, you have to set up and maintain a minute book for the corporation and do separate tax filing. So all of that can sort of add up to the amount of work involved and to the amount of money and fees that you end up spending on lawyers and accountants, which come in a lot of times at the very early stages of your business. So when you incorporate a business, it basically acquires all of the powers of a person. The corporation has its own existence, separate from its shareholders. So shareholders are the owners of the corporation. For corporations, we call them shareholders. And a corporation has an unlimited life expectancy. So can live way beyond us. Because if a shareholder dies, the corporation does not die. The only way to end the life of a corporation would be to dissolve it, and the shareholders make that decision. Unlike sole proprietorships and partnerships, corporations can own their own assets. So going back to sole proprietorship, if I buy an asset for the business, say some piece of equipment, a vehicle, whatever, it all needs to be in my personal name. It can't be in the name of my business. But if it's a corporation, if my business is a corporation, then my business can own the asset. Freibus Cafe Ltd. As a corporation can own an asset, can have a name, even if it's real estate, can go into debt in the name of the corporation. enter contracts, sue, be sued. So just like a person, a corporation has all those powers. Ownership interests in a corporation are easily changed. So shareholders of a corporation are the owners. Once a corporation is set up, shares are issued to different shareholders. And if shareholders want out, then they just transfer their shares to a new shareholder or to one of the existing shareholders. It doesn't affect the corporation, its existence, or its operations. So it makes those types of transitions a little bit easier than it would otherwise. With corporations, one of the big attractive things is the limited liability. So because a corporation is its own entity, the shareholders' liability are limited to the amount of their investment in the corporation. For example, and I should also, I guess, mention that generally shareholders are not really held liable. If, let's say, Freybus Cafe Ltd. is a corporation, of course, and somebody sues that business, the shareholders are not exposed to the liability. It's just the business. So whoever sues that business, they can go after the assets of the business, but not after the shareholders themselves. In terms of the creditor claims, I guess I did cover that. There are very limited situations where a creditor could go after a shareholder. Generally, if you're a shareholder and also a director, your liability is you're exposed to a bit more liability, more in the role as a director than a shareholder. But for the most part, shareholders have no liability towards creditors, unless, of course, they have guaranteed the obligations of the corporation, then it changes the situation. Perpetual succession. So corporation is a separate legal entity. It doesn't depend on who the shareholders are. Shareholders can come and go. It doesn't really change things for the corporation itself. It can just continue existing. I should also mention, before I get into the tax stuff, is in terms of the management of a corporation. So when you set up a corporation, you issue shares to shareholders, and then the shareholders appoint directors of the corporation. And those directors are the ones that run the affairs and manage the corporation. So in a lot of small businesses, though, the shareholders are the directors, right? But in the larger corporations, then the shareholders are not all involved in the running of the business. So they have directors and officers, president, CEO, and whatnot. And they are the ones that operate the business. So if you think of a large public company such as Google or Facebook, the shareholders are not at all involved in the running of the business. Compare that to a small company that you might be running and you're doing everything, and you're a shareholder and a director and an officer and everything else. So in terms of taxes, there could be possible tax advantages when you're running a corporation. It depends on the amount of income. There's this small business tax deduction for the first $500,000 of your income in the company. You pay a much lower tax rate, so 9%. There's some limitations in terms of how much capital you have invested, but for most small businesses with under 10 millions in capital, you could take advantage of the first $500,000 and the lower taxes. The other good thing about corporations is that you can leave money in your corporation for further investment in the corporation. And You don't have to necessarily take all the money out. Whenever you take money out, you pay yourself a dividend as a shareholder, and then there is some taxes that can be paid, that would be paid personally as well when you receive dividends. But the lower tax rate is at the corporate level. So it can be advantageous if you are, for example, looking to expand your operations or buy more capital assets in the business, so you can take advantage of the lower taxes, save some money, and buy assets or whatever else you need to do for your business. Corporations are very easy to raise capital for because you can bring an unlimited number of shareholders. I mean, you can do that with partnerships as well, but with corporations, you can bring in shareholders with different types of voting and non-voting powers. A lot of times there are shareholders that just want to invest and want to get paid out dividends, but they don't want to have to run the business or incur any type of liability. So as a partner, it would be hard for them to come in, but it's a lot easier to do that as a shareholder. Okay, so I do have a question about the small business deduction. And the question is whether that applies to provincially registered corporation, or does that apply if you incorporate federally? And the answer to that is it applies to federal ones as well. Okay, so in terms of raising capital, as I said, sorry, I'm just making sure there are no more questions. Okay, so in terms of raising capital, it's easy to bring in new shareholders. It gives them a bit more confidence to join the company without having to be exposed to unlimited liability, as would be the case in partnerships. A lot of times with the type of business and the amount of investment you require, even banks might require you to incorporate your business before they give you a large loan, or if you're looking to raise private equity, you may need to be an incorporated business. Corporations are closely regulated. So like I said, in a sole proprietorship, you just set up your business, you have full control. You can basically do whatever you'd like to do as long as it's legal. But with corporations, the Business Corporations Act has regulations that need to be followed. There's rights of shareholders, especially minority shareholders, what the rights and responsibilities of directors are, and what happens to the corporation in different circumstances. So generally, it's the most expensive form of business to organize. Like I said, at the beginning, you have to incorporate, the fees are higher, the process is more complicated. You would generally need a lawyer or an accountant to help out. Very much like partnership agreements, you may want to consider having a shareholders agreement in place. And that's sort of similar in that you can set up the terms of the relationship between shareholders, set up terms in terms of succession, what happens if a shareholder would like to get out, what happens to their share, whether they're allowed to sell their share to a third party, or whether other shareholders can buy their shares. Those are very important things to remember. And so a shareholders agreement comes in very handy. And it's, again, highly recommended. And we'll touch base on that in one of our upcoming sessions when we talk about partnership agreements. So having a shareholders agreement, of course, adds to the cost, especially if it's a small business looking to set up initially. The charter documents would be your articles, which outline the types of shares in a business, the bylaws, which sort of talk about the sort of how the corporation is governed, how shareholders conduct their meetings and directors and all of that. USA's would be the unanimous shareholder agreements, and also the Business Corporations Act and the restrictions in there. So there's all the stuff that you need to follow in order to operate your corporation. You also need extensive record keeping. CRA requires that you keep records of the corporation. Again, because it's a separate legal entity, you have to keep the records for a certain period of time. You also have to keep records to abide by the Business Corporations Act regulations, like I said, the minute book and whatnot. So it can be quite complicated. And sometimes, depending on how large your business is, if it's not very large, it may not make sense necessarily to have a corporation. The unlimited liability is great, but that might not be sufficient of an incentive to incur the costs right up front. The other thing is the personal guarantees. So, like I said, the advantage of having a corporation is limiting your own exposure and liability. However, with a lot of new businesses, sometimes even very large established businesses, if you're taking out a large loan from the bank, they're not going to just give a loan out to the corporation. They would require the shareholders to sign personal guarantees. And a personal guarantee basically means that you're guaranteeing the obligations of the company. So if the company can't pay back its loan, then the bank can come after you personally. And then that exposes you personally to that liability. Of course, you can have a limit in that guarantee, can be limited to the amount of the loan. But there is that aspect of it to remember. And once you do a personal guarantee, then you're exposed personally. Again, if they take out the judgment, your personal assets are exposed to that. So that's one thing to remember. So a little bit about federal incorporation. In Saskatchewan, we incorporate under the Business Corporations Act. There's the option to incorporate at the federal level. And that's recommended if you think you'll be operating in more than one jurisdiction. So anytime, if you set up a business or incorporate a company in Saskatchewan and then decide to go also sell your goods or services in Alberta, Alberta laws require you to be extra provincially registered in Alberta. And vice versa, if you're an Alberta corporation and you're looking to come to Saskatchewan and operate here, Saskatchewan laws would require you to be incorporated here extra provincially. So for businesses that are looking to operate across Canada or maybe eventually outside of Canada, then it might be a good idea to incorporate federally. It's sort of similar. It's the federal statute that would apply here. Even if you're incorporated federally, you still need to be registered extra provincially in each province that you operate. The good thing that the federal incorporation does is that it gives your name protection across the country. And just to explain that a little bit, so if I am looking to incorporate Freybus Cafe in Saskatchewan, anytime I want to register that business name either as a sole proprietorship or to incorporate, I have to request a name search. And I would only be able to use that name if it's available. So corporate registry goes through its own records to see if there's any other similar names. And if there are, I wouldn't be able to use that name. With some exceptions, I can get consent. But, and that would be the process in every province, right? So if, however, I incorporate federally, it gives that name protection across the country. So that way, if I later on decide to go to Alberta or go into BC and expand my operations, I would have my name, I would have that availability. So that's sort of nice. In terms of name protection, I should also say that you might have heard of trademarks registrations, and that's something that would get discussed in a later session by one of the other lawyers. And that gives you a lot more protection in terms of your name and in terms of your trademark and all logos and symbols that you use for your business. So that's something very important, and we figured that was an important topic for small businesses because a lot of times that's something you don't even think about. And as your business grows, you realize that your name has been used or being used elsewhere. So a really important seminar to attend. And it will touch base on the name protection, trademarks, and stuff a lot more. Okay, so in terms of transitioning from one business structure to another, so previously I did talk about, thinking about your business structure prior to setting up a business, because it makes everything much easier a lot of times to set it up the right way instead of having to go back and fix things or change things. But oftentimes it just doesn't make sense. If you're a very small business, it might make no sense for you to incorporate. So you might decide to start as a sole proprietorship, and that's perfectly fine. You do have the option to change that to a partnership in future or even to a corporation. One thing that I would mention though is that you have to make sure it's done properly. And a lot of times you may need an accountant and a lawyer to draft up the paperwork, because you want to make sure the assets are transferred from the sole proprietorship to a partnership or to a corporation under certain income tax provisions that would make the rollover not have any tax consequences for the rollover. So there is the possibility of changing your business structure down the line, but you just have to make sure it's done properly. So just to wrap up, in terms of your business structure, it's very important to decide what business structure is appropriate for your type of business. The main things that a lot of times we talk about are really the taxes and liability. And depending on the type of business and how large the business is, those issues might be important or not so relevant right off the bat. My formal part of my presentation is over, so I'm inviting anybody with questions to feel free to type in some questions, and I'm happy to answer them. Okay, so I have a question. The question is, are there ways to limit liability within a partnership structure? So as I mentioned, partners are liable, and the technical term is jointly and severally liable for all of the liabilities of the partnership. So what that means is I'm 100%, if there's a loan for $100,000, I'm 100% responsible for the entire $100,000, and so is my partner. The bank can go after each of us for the entire amount. But one way to sort of help with that would be to have a partnership agreement that talks about limitation to liability of each partner. So in the agreement, we can agree that each partner is only responsible for up to 50% of that liability because we are each 50% partner. But that doesn't still make the bank go away. The bank can still come after you for the whole amount. What that gives you is the ability to then turn around and go after your partners for the rest of it. So you would still be liable to the bank for $100,000, and you can go after your partner for the rest of it. And that can be challenging because then you have to sue your partner based on his or her promise in the Partnership Act to be responsible. And usually the reason banks go after so if I'm acting for a bank and I'm going after the partnership loan that's outstanding, I will include all the partners and we get judgment against everybody. And then we go collect on the judgment, but we collect it from the partner that has the most assets. So again, if you're that partner, the bank can collect from you up to $100,000, then you have an action against your partner for the rest of it. But it makes it still hard for you to go collect. I hope that answers your question. Okay, we'll give it a few more minutes for any other questions that you might have.
Just while we're waiting for any last questions, I'm just going to pop in and say thanks, Freba, for kicking off our legal series today and for the fantastic presentation today. This is one of the questions we get asked all the time, so it's great to have a resource for those to refer to. And as I mentioned before, this will be available for on-demand viewing, so we can watch this at any time in the future as well. Thanks to all of those who attended today's webinar and took the time out of your busy schedules to be here. We appreciate it. And don't forget to check our events page at wesc.ca/events for the release of those 4 remaining January topics. Our next webinar is happening next Wednesday, December 9th, and is titled Set Yourself Up for Success in 2021. And our presenter for this is Carrie Schwebis of Elevate Executive Coaching. Registration for this one is open on our website, and we hope to see you then. If there is no other questions, I think we will wrap up, but feel free to follow up with myself or potentially you, Freba, if you have any further questions.
Yes, I'm happy to answer any further questions. I provided my email address at the beginning of the presentation, so you're welcome to shoot me an email if you have questions or if you just want to chat. Thank you so much, WESC, for having me. It's been a pleasure, and thanks everybody for attending the seminar. Oh, there's a question, so I think we have a few minutes, so I'll take that. The question is, which kind of business structure would be perfect for a new online market in the province, partnership or corporation? So the answer to that, as a lot of answers from lawyers, would be it depends. It depends on the type of business. Some businesses are a lot more exposed to liability than other businesses. So the type of business you're operating would sort of attract more liability depending on what it is. If you're looking to later on expand into other provinces, maybe a corporation is a better structure because then again, it protects you from liability as you expand your business. And again, what I talked about in terms of taxes and how much income you're expecting to generate in the first couple of years would be a factor that you have to think about. So if you're looking to make just $50,000 or less, chances are you don't want to go through the costs of incorporating unless you're really concerned about liability. So I hope it answers your question. If there are no more questions, I think we can wrap up. Is that okay, Josie?
Yeah, that sounds good. I think we've answered all of the questions, so we'll let everybody go. And thank you again for joining us.
One more question.
Oh, there's one more. Oh, I'll hand it back to you.
So for a sole proprietorship, can liability just be mitigated with insurance? Yes and no. You cannot get insurance for bank loans, for example. You could get insurance for things like third-party liability, errors and omissions. So if, like I said, somebody slips and fall, your insurance might cover that, but it doesn't necessarily cover you or protect you from any and all liability. So you have to look at your business and the type of business. There might be specialized insurance policies for your type of business. And you want to be really careful in looking at your policy and reading your policy to see what kind of liability it covers you for and to what extent and what you need to do in order to make sure you qualify. Because a lot of times you end up buying the policy, but then there's fine print that have exclusions. So you want to make sure your policy, you understand your policy and understand what kind of liability you're covered for. But you're not going to be fully covered by insurance. Okay, I don't see any other questions coming in. So I just want to take a moment to thank everybody again. If you need any help from us, we have lawyers in our office that specialize in different areas of law, not just corporate commercial. So if you need any help, feel free to reach out. If you just have some general questions and just want to chat, feel free to reach out as well. You do have my contact information. Otherwise, feel free. I'm sure Wesk would be able to provide that to you. Thank you again for having me.